Have you ever felt overwhelmed by the chaos of the stock market? Maybe you've made emotional decisions, buying when prices were soaring or selling in a panic when markets dipped, only to regret it later. Or perhaps you've been tempted by hot stock tips that promised overnight riches but left you disappointed. Benjamin Graham's The Intelligent Investor offers a roadmap to financial peace of mind in an unpredictable world. This isn't a book about quick fixes or speculation. It's about mastering the timeless principles of investing to achieve long-term financial security. Graham's advice is more relevant than ever in a world where people are constantly bombarded with financial news, market volatility, and get-rich-quick schemes. Graham teaches us how to protect our wealth, grow it steadily, and avoid the pitfalls that cause most people to fail in the market. It's a guide not just for investing but for thinking logically about money, a skill that can transform lives. The problems investors face and how Graham's book solves them. 1. Emotional decision-making in the market. Humans are emotional creatures. When markets soar, many of us feel the fear of missing out and buy at inflated prices. When markets crash, fear takes over, and we sell at a loss. These emotional swings often lead to poor financial outcomes. Graham addresses this by teaching us the importance of discipline and a rational mindset. He introduces the metaphor of Mr. Market, a fictional character who represents the stock market's mood swings. Some days, Mr. Market is euphoric, offering to buy stocks at sky-high prices. Other days, he's depressed, selling stocks at bargain prices. Graham advises us not to follow Mr. Market's moods, but to focus on the intrinsic value of our investments. What is the solution? By staying calm and rational, we can take advantage of market fluctuations instead of being victimized by them. For example, when others are panicking and selling, that's often the best time to buy. 2. Confusing speculation with investing. In today's world, it's easy to confuse speculation with investing. People chase trends, gamble on meme stocks, or pour money into unproven cryptocurrencies, hoping for quick returns. Graham draws a clear line between the two. Speculation is akin to gambling. It's betting on short-term price movements without understanding the underlying business. Investing, on the other hand, involves thoroughly analyzing a company's fundamentals and buying it for less than its intrinsic value. Solution: Graham teaches readers to be true investors, focusing on the long-term value of their assets rather than short-term price fluctuations. This approach minimizes risk and maximizes the potential for steady wealth accumulation. 3. Overpaying for stocks. One of the most common mistakes investors make is overpaying for stocks. This often happens during market booms when prices are inflated by hype and optimism. Graham introduces the concept of intrinsic value, the true worth of a company based on its earnings, assets, and potential for growth. He advises buying stocks only when their market price is significantly lower than their intrinsic value. This creates a margin of safety, protecting investors from losses even if the market turns against them. Example: imagine a stock is worth $100 based on its fundamentals, but it's selling for $70. By buying it at a discount, you reduce your risk while increasing your potential gains. Solution: the margin of safety is a critical tool for protecting your investments and achieving consistent returns. 4. Lack of diversification. Many investors put all their eggs in one basket, investing heavily in a single stock or sector. This lack of diversification can lead to catastrophic losses if that investment fails. Graham emphasizes the importance of diversifying your portfolio across different industries and asset classes. For defensive investors, he recommends a balanced mix of high-grade bonds and blue-chip stocks. For enterprising investors, he suggests identifying undervalued stocks but still maintaining diversification. Solution: diversification reduces risk and ensures that no single failure will devastate your portfolio. 5. Overconfidence and market timing. It's easy to believe you can outsmart the market. Many investors try to time the market, buying and selling based on predictions of short-term movements. But even seasoned professionals often get it wrong. Graham warns against overconfidence and market timing. Instead, he advises focusing on long-term value and ignoring daily market noise. Patience and discipline are the hallmarks of successful investors. Solution: stop chasing trends and trying to predict the future. Instead, invest in solid, undervalued companies and hold them for the long term. Key concepts from the book. 1. Defensive versus enterprising investors. Graham identifies two types of investors. Defensive investors. These are individuals who prefer a hands-off approach. They prioritize safety and minimal effort, focusing on stable investments like bonds and blue-chip stocks. Enterprising investors. These are hands-on investors willing to put in the time to research undervalued stocks. They take calculated risks but remain disciplined and analytical. Takeaway. Whether you're a defensive or enterprising investor, Graham's principles apply. Choose the approach that suits your personality and goals. 2. Mr. Market. Graham's Mr. Market analogy is one of the most famous concepts in the book. Think of Mr. Market as your business partner who offers to buy or sell stocks every day. His moods swing wildly. Sometimes he's overly optimistic, and other times he's irrationally pessimistic. Graham advises ignoring Mr. Market's emotions. Instead, use his irrationality to your advantage. When he offers you stocks at a low price, buy. When he's willing to overpay, sell. Takeaway. Don't let market fluctuations dictate your decisions. Focus on value, not emotions. 3. Margin of safety. The margin of safety is a buffer that protects you from errors in judgment or unforeseen market conditions. By buying assets for less than their intrinsic value, you minimize risk and maximize your chances of success. Let me give you an example. If you're buying a house worth $200,000 but pay only $150,000, you have a margin of safety that protects your investment if the housing market declines. Takeaway. Always insist on a margin of safety when investing. 4. The importance of fundamentals. Graham urges investors to base their decisions on a company's fundamentals, its earnings, assets, and financial health. Avoid being swayed by hype, trends, or speculative bubbles. Example. During the dot-com bubble, many investors poured money into internet companies with no earnings or viable business models. When the bubble burst, they lost everything. Those who focused on fundamentals avoided the hype and preserved their wealth. Takeaway. Stick to companies with strong fundamentals, even when it's unpopular. Why Graham's advice is timeless. Although The Intelligent Investor was written decades ago, its principles are as relevant today as ever. In a world filled with speculative bubbles, market volatility, and information overload, Graham's emphasis on rationality, discipline, and value remains a beacon of clarity. Even legendary investor Warren Buffett credits Graham's teachings for shaping his investment philosophy. Buffett describes The Intelligent Investor as the best book on investing ever written. The Intelligent Investor isn't just a book about making money, it's a guide to achieving financial security and peace of mind. Graham's principles of value investing, the margin of safety, and emotional discipline can help anyone build long-term wealth while avoiding the pitfalls of speculation. By following Graham's advice, you'll not only protect your investments but also gain the confidence to navigate the stock market with clarity and purpose. This isn't about getting rich quickly. It's about growing wealth steadily, safely, and intelligently. So, if you're tired of chasing trends, making emotional decisions, and losing sleep over market volatility, this book is your solution. Read it, internalize its lessons, and start your journey to becoming a truly intelligent investor.